Good morning, ladies and gentlemen. Well, risk dial stuck really in the green. 55, it keeps on just going up. As you can see in this box between sort of the 60s and the 50s, nothing really to write home about. These differences are very small. We are stuck in risk on. I have very little doubt about that. What I'm interested in is those levels where we switch to risk on, which are basically where the market is now. So all we have done is basically retraced towards the levels of where we started the risk on. The question is, do we retest them further, or do we now start going up? And that is the evidence that I'm going to be examining this week. I'm pretty positive about the markets from good levels. I see that nothing has changed. The central banks are still in print mode and will continue to be in that mode for a long, long time. Christine Lagarde told us so this week. So the question is really, from what level do you buy the market? What are the spreads of the internals of the market showing you? And what the sectors themselves are showing you as the evidence is from where a bottom will be. Deviations, well, there isn't a single sector now that is overbought and in the red or very much oversold. Pretty neutral, exactly where the market is always tends to go ahead of big events. The fact that we are now seeing this compression in the zones is actually what is an omen of a bigger move to come, but not just now. I think the trend is going to be for these to compress further. If we look at the individual sectors, apart from XLE, which is, poor thing, always getting slammed against relative against the rest of the market, all the other sectors are very much towards the bottom of the band or the middle, and are therefore neutral. There's very little really to worry about in these sector spreads, and this is the interesting one, XLK. So basically, as I told you last week, everything is going to be in the sign of technology. Technology is deflating, and we will examine the evidence later on for where it's going. Is it going to make another dip and then rally, or is it just going to rally from here? The odds are fairly balanced now, whether we have seen the bottom of the market or whether we get one last leg lower. But I have no doubt that eventually all this resolves higher. The question is, where do you buy it from? I think it's going to be another few weeks of inconclusive meandering before we are ready to make the move, and we will probably make the move in late October, just before the US election. So just before we start examining in detail what is happening in the internals of the stock markets, let's have a look at the weather. And basically the bond markets and the US dollar make the weather that the stock markets have to respond to. Well, if we look at what is happening in Europe, absolutely nothing. This is the bubble. It's stuck between minus 61 and minus 75, 76 basis points. If I told you that for months and months the bubble will trade in a 15, 16 basis point range, you probably wouldn't believe me. But it will continue to do so, I think. But we will see. It will tell us. I think the bubble and the Bund are going to tell us. This is the Bund. It's basically trading between minus 40 and minus 60. It basically, that's a 20 basis point range. It will give us a warning. It will start closing up above here or below here and give us a very good warning that volatility is real volatility, permanent volatility. A macro shift is happening in the markets, and therefore that permanent volatility and real volatility will be present in the stock markets. While it's just meandering like this in a 10-15 basis point range, it's basically telling us stability. And the central banks have basically told us, Lagarde was very, very dovish, I thought, and very decisive again. She's worried about the US dollar, but not really that worried. She'll be really, really worried at 125. She is concerned at 120, and she's quite happy at 115. So, what is there to say? While the bond markets are giving us no clues, the yield curve is giving us no clues. It's tough, really, to get too excited about the movements in the stock market. Relative movements of 2-3%, meaningless. 2s, 10s, completely stuck at 53 basis points. I mean, 2-3 basis points ranges. It tells us that the market is fast asleep. The central banks are not allowing it to move, and therefore the movements in the stock market can only last for so long or go so far. I monitor the whole of the US yield curve, and really I haven't seen a period of stability like this not in my lifetime. If we look at the 3 months, the 5 year, which I think is very important for XLF, we are within a couple of basis points, and we have been there, since really, I don't know, May. It is flatlining. The only things which have moved slightly have been the 5s, 30s and the 5s, 10s, but they are actually very nicely contained. While the central banks managed to contain the 5s, 10s above this minus 48 level, I think we are doing nothing but basically trading normally in a 3-4 point basis range. And while they managed to contain the 5s, 30s, which is from the belly to about as far out as it counts for the stock markets, around this 140 level or above 140, say between 105 and 140, the weather is good for stocks. I can't see that it's bad. I can't see that anything that the stock markets do while we are in that kind of a range is permanent. It is just normal trading. I would start getting concerned now if the yield curve started really flattening above 105. That would be a sign of risk off, I think. But until it does that, I think don't forget this is a weekly chart, so you can see how long. I mean, I waited for something like 7-8 weeks to see it up here to resell it. So these are minute movements, 20 basis points. I remember when the yield curve used to move 20 basis points in a day. This is now trading in slow motion. And while it's happening, and we will have a look at the dollar next, the likelihood of big ranges and big volatility, macro big volatility in the stock markets diminishes ever further. What to say about an asset which basically closes within ticks of the previous week's close? And this is a weekly chart of Euro USD. Now it's been 1, 2, 3, 4, 5, 6 weeks that it's closed within 1% of where it closed the week before. It basically is just non-trending. What is significant about this chart is that it is consolidating in the upper part of the range. The reactions lower are, ever lighter, and also that the weekly Bollinger Bands are expanding. What does that tell me? That tells me that this kind of area, the 115, 40, 50, 60 area, is very good risk reward for a very good bounce. Are we going to see one of these developing and then up towards 125? I don't know, but the central banks have now more or less told us that this is the level that they're going to be unhappy at. I think the market certainly gets to levels where they are unhappy, but it will probably be several weeks before it does so. Um, it, we, you know, it. If we now have a look at what that means for Dixie, I have not really changed my mind at all. I think from the 95 to 95.50 area, this kind of area, it's a great risk reward for a move down into probably the 80s and this kind of level 88. But I'm not going to trade it here, and I see absolutely no reason. This trend line, and this is the equivalent of that trend line on the dailies, has been in place for many years, and the market just doesn't have the oomph to bust it at the moment. It's just trading around very close to it, turning all the moving averages. It probably needs another 2, 3, 4 weeks of trading there before it starts breaking down. I think the US needs a lower dollar. I think they will engineer a lower dollar, and they will engineer a level where the ECB is unhappy, i.e. that 124, 125 level. It's just a question from where does it go. I think this kind of level, 95 to 95.50, is the level that we probably have to retrace to before we have the oomph to break down lower towards this 88 level. Again, it's all about risk reward, and risk reward is from that 115.50 level in Euro USD. Okay, so what happened in the stock markets last week? Well, nothing apart from a continuation of the deflation of the technology bubble. These are XLF, XLK, XLV, XLK, XLI, XLK. As you can see, in all of them, the market basically went up a little bit and closed down the difference that it has against the moving averages in the respective moves. Down here we have the Qs against SPY, NDX index against the SPY, QQQ against the IWM. Basically in all of them we have gone back down to close the difference against the moving averages. And this is what markets do ahead of big events like the US election. Basically, the asset which is the most overbought, people book it. People basically look for to hug back the index. What people had done, they had gone overweight technology. A, because it made sense, fundamental sense, and B, because it was the momentum trade, and now they're deflating that momentum trade and going back to hugging the index. And the index they want to hug is actually the SPY. So that is what should continue to happen, I think, over the course of the next couple of weeks. Every time there's a rip, especially in technology, it's going to get sold big time by the big players, and every time there is a big dip, people will be adding to the index component. So we have two forces at work. We have a force on the, limiting the upside, and we also have a force limiting the downside. I see this movement continuing. The question is, does it I think 0.7972 trades over the course of the next couple of weeks, and I think these sectors are going to do slightly better. RE, XLF, XLV, XLI are going to be doing slightly better against XLK. No big deal, and that basically gives us passes the time until the market gets to a point that it can really take a decision about which way it wants to trend, because then every component will be in a position to make a breakout. Again, this is actually going to show you exactly what is happening, because this is EWG over EWJ, so Germany over Japan. These are weekly charts, completely stuck, not moving anywhere. SPY over Japan, down. SPY over FEZ, that is basically the stocks equivalent with, in constant dollars, so it's all dollar dollar, down. SPY over EWG, so SPY over Germany, down. So basically the SPY is deflating itself, and the sector that's deflating the SPY is actually tech. So momentum is going down against value, and I think that is a movement which can continue for several weeks until we get to the, just before the elections, when I think the market will start to climb the wall of worry. It's going back basically to this line. So what this is telling me is that Europe is going to be very stable, continue to be very stable. I don't know whether you noticed. I'll show you a chart in a moment. Basically, Europe has been doing nothing all week. When it was bid when the S&P was above 3,400, and it never really went off it. Even when we started testing the 3,300s in the S&P. So that tells me that it's an S&P, it's a US specific thing that is going on. It's not a macro market thing. And that makes sense. People were very, very long of it. And as I told you, they're going back towards hugging the index and really being safe while hugging the index, and not wishing to stick their necks out, because what's the point? That's what money managers do just before a big event. They stick to the index. Well, this is a chart of the transports against industrials. I made them both dailies. And you can see, compare and contrast what is going on. I think the transports are telling you the economy is just fine. There's no problems. I haven't seen anything significant in the past couple of weeks. They're, very close to the absolute top of the range where we were here in the industrials. The industrials have been deflated by stocks like Apple, and it just makes sense. People are going, this sector is telling you what is going on in the real economy, and this one is telling you what is going on in people's positioning, is my opinion. Basically, nothing is changed in the economy. Nothing has changed in the direction of the spreads that we could see from the risk dial. What is happening is a deflation of tech. And here we have a VIX chart against the VXN, which is the volatility of the Nasdaq. So volatility of everything as opposed to volatility of just mainly the tech sector. And you can see how they remain, the volatility of the tech sector remains elevated against the volatility of the VIX. They both got slammed late on Friday, which makes absolute sense to me. But the volatility here remains well elevated. It's well higher where it was 2 weeks ago, while it's on the VIX itself, it's actually exactly where it was. So basically, we have negated the whole move in VIX. We have not negated it in VXN. So to me, this says the volatility of the tech sector will remain higher, and the chances for pullbacks in the tech sector are much higher than they are in the S&P itself. What does all this mean for the important levels of the market? I mean, last week I told you that the market was very unlikely to go below the 3280, 3300 region, and that is exactly where we stopped, and we couldn't do much better. Then we tried the upside. This is a weekly chart. We'll look at the daily chart a bit later on. And basically closed as a result of the fact that that we are worsening in tech and deflating that bubble. We closed slightly lower on the week. Basically, the title of last week's piece was Panic in Place, and that's exactly what we did. We panicked in place. We went up and down 100 points like crazy for no reason whatsoever, apart from tech was slowly deflating. And that's why we closed slightly lower. End of story. Where are the big risk-reward points? Well, the big risk-reward points are around the 32.75 area, and then finally around the 32.10.20 area. I will be a monkey's ass if we trade and close below 32.20. Absolutely, I think the odds of that are so small it's not even worth considering. I think over the course of the next few weeks we might see that level, but that depends very much if tech can break the levels that I will examine slightly later on. Otherwise, I think for the next six bars, which is 6 weeks before the market starts deciding which direction it wants to go, before the election, we will be stuck. And so I'm making a 6-week prediction here. We will be stuck between 32.10.20 and I would have thought no higher than 34.40. Okay, I think 34.40 is a very important level. So 34.40 down to 32.10, and I think that is a generous range to give it for the next, call it 4 weeks. I think this is an environment which is made for selling puts around that strike and basically buying ratio puts every time the market goes 1% above 3,400. The likelihood of us continuing the trend until, let's say, a week or two before the elections, to me, are very, very small. I think probably we need to make everyone crazy by whipping around in that range for quite a long time. From a daily chart, you can see that we really lack definition here. What we have basically done is broken the moving averages, and we are turning them, but they're remaining fairly neutral. They're not pointing hard down. We have the Bollinger Bands basically for the next few days. Very supportive, anywhere below 3,300. I see absolutely no reason unless tech starts behaving very weirdly, why we would break and close above this level, which is 34.25. Basically, that is what we need to do if we want to go back up towards the top of the range. I find that very unlikely. I think big money managers are waiting with bated breath to smack it in that area. And we are also unlikely to break the 32-33 level. Looking here to fill this gap around the 32.70 area, and I think that's as bad as it gets this week. And on to NQ, which is the one worth watching, the only one worth watching, the one that is going to tell you exactly where we are in all the other sectors. I can almost price S&P to the 3-4 ticks by if you tell me where NQ is. Now, as I told you last week, this 11,060 area is the first good risk-reward point, and when we got there, we bounced like crazy all the way to 11,500 and gave it all back by the end of the week. What does that tell me? That tells me A, that it's a very important point, and B, that at some stage, if this is not the bottom, the danger is this area, the 10,300 to 10,150. I think the danger beyond there is almost zero. That would also be the 38.2% retracement of this whole rally in in the Nasdaq, and you can see how many weekly highs and lows there are at that level. So the danger is that we haven't seen the bottom, that we basically every time the S&P rallies a little bit, the say towards 3400, the Nasdaq does a little bit less, and at some stage over the next, I'm not going to say next week, but at some stage over the next 2, 3, 4 weeks, it actually breaks and does an ABC down to that 10,300, 10,150 area. The risk reward here is fantastic. Okay, it's absolutely brilliant. I think you can see 1,000 points in like 2 weeks, or even less. To me, that is a great spot to get long or have some call spreads, but we will decide which the best strategy is in the when it happens. The risk reward here is not it's a 50-50. It's not bad, but it's not fantastic. I think the deflation of the tech sector is going to continue simply because I think people have been too long, and really everyone needs to puke it out. But I think it's a sector specific thing rather than a market problem. There are no macro problems. There is nothing but people's positioning which is in the way of NQ. And I think that is going to happen over the next course of the next couple of weeks. I think we will get a really, really good risk reward ahead of the election, and we have to be prepared to seize it with both hands. Last week really was exactly as I thought it would be. I see no reason to change very much, not because I have recency bias, but because the technicals and the fundamentals tell me that not a lot has changed and not a lot is likely to change. The 2s, 10s are absolutely anchored. The 5s, 30s are behaving exactly as they should be. This is the level I'm watching because that would be the risk off level, and I think that is the danger side for the risk market. Of course, if it went through 140, something else is going on, but I think the odds are so low that I'm not even going to bother, looking at it. I've changed nothing here in the dollar index. I still think that 95.5 level, which corresponds to 115, 50, 60, 70, who cares, is going to be great risk reward to be short of the dollar. Gold I haven't shown you this week because absolutely nothing has happened and absolutely nothing has changed. Still, the 1860s is the only level that I'm really considering going long, and the resistance is around the 2020 area of the weekly Bollingers, but who cares? I'm not going to be buying out there, I'm not going to be selling it up there. This is the only level I'm interested in trading at. Why? Because of this. I think the only impulsive waves are going to be to the upside, corrective to the downside. Why? Because the bonds are absolutely stuck and the dollar, I think, is going to get weaker. I think this 1860 could coincide with this area, and that is what I'm looking for. I think these risk rewards match each other well. I've changed very little here for the S&P and NQ because I really don't see any reason to change anything. This is where I said 3280, 3300 is massive. What was the low? 3295, something like that, before it rallied 100 points. And I'm now adding this 3210 to 3230 is going to be an absolute gift. I don't think it happens next week. I think it's going to take quite some time to get there, and it's going to get there through deflation of the tech, and that's the only way it's going to happen. So if you think about it, if we match this 10,300 to 10,150 level, say that is 6-7% in tech. Well, if tech is the third of the S&P, that means that the rest of the sectors do absolutely nothing really, and that drags this move here drags the S&P down to that level. I think that's a gift in NQ, and that's a gift in SPX. They would need to do these, both the SPX and the NQ would need to do a lot to the upside. They would need to close at least twice, 34.25, above 34.25.30 and above 11,600 to start changing the technical picture. I think that while money managers are overweight, while the uncertainty about the election is high, that is unlikely. I think we will definitely make a move before the election, but I think the odds are quite high that we could see these levels, the 32.10.30 and the 11,060, just before it, and then go from there. I think that is what I will be waiting for. In the meantime, you just keep on selling puts struck at those levels. You keep on doing, when the market rallies towards these levels, basically you keep on doing 1x2s, 1x3s. Volatility is not gonna come crashing down anymore. I think this is about as bad as we're gonna see it, within 5 to 10%. So given that, I think ratio spreads and outright put selling at these important strikes is the way to continue next week. Thank you very much indeed, and tweet you on Monday.